All right. Well, it looks like people are starting to trickle in. Appreciate you all being here. It's 1 p.m. Eastern Time on February 18th. This is another ISA webinar that we are digging into on everyone's favorite topic of the month. I say that slightly sarcastically, but it's certainly a big topic of conversation, both on the manufacturer side, distributor side, supply chain side, customer side. Everything is really being impacted by the big T word, tariffs. So we're bringing you guys a conversation between some folks that really have dug into this topic, because you got to build your contingency plans. You got to build, some structure around how you're going next. And so please, I encourage you to engage in this webinar. The chat is open and you can submit your questions through there. We'll try to answer them in real time. If it's something that's not necessarily related to what we're talking about, we can answer it at the end, or we can follow back up with you at the very end. But I'm going to turn it over now to our speaker, who has brought some guests, and I'm going to let him introduce his guest today. But Mark Gillum is with Enable, who is a trusted partner of ISA, and really a big supporter of a lot of the things that we're doing to advance the channel. And so, Mark, welcome. Thank you for bringing this topic up. Thank you for your insights that I found on LinkedIn and reached out to you and said, can you do a webinar for me? And Mark was gracious enough to be here. So, Mark, I'm going to turn this over to you. Please feel free to take it away and introduce your guest, and then I'll come back on the tail end and maybe ask some questions of my own, okay?
Brilliant. Thank you, Brendan. And so pleased to be here. As you can tell from my accent, anybody who doesn't know, they're probably thinking, why is Mark talking about tariffs? And the reality is that's why I'm delighted to introduce Omar, who is here from Inside Beltway. What we're going to do today is we're going to talk about tariffs through two lenses. Omar's going to talk for the first session today very much about an overview of the tariff space, and bring a lot of insight and education to everybody. And then what I'm going to do is talk more practically, looking at how that is going to actually affect our organizations from things like accounting practices, pricing, and various lenses, such like. So without further ado, because I know Omar has an incredible amount of information to share, and I'm really looking forward to this. I dashed through the slides and thought this is going to be an amazing session. So Omar, I don't know if you want to briefly introduce yourself and then take it away with your presentation.
Thank you, Mark. I appreciate that, and Brendan and team for having me here. I'll go ahead and start sharing my screen here now as well. And I might have over time met some of you and some of your folks over time in that I should have screen being shared now. And I am a lobbyist in Washington, D.C. For those that I've not met before, my name is Omar Nashashibi. I'm the founder with a firm called Inside the Beltway Solutions here in Washington. I've been a lobbyist for 25 years now. I first started working on trade and tariffs on behalf of the stamping industry, Precision Metal Forming Association, back in 2001 when W. Bush put the tariffs on steel. I currently lobby on behalf of the National Tooling Machining Association, the American Mold Builders Association, die casting, forging, valve manufacturers, screw machine shops, National Tooling Machining. So quite a bit of downstream, everything, some tier ones, but a good amount of tier two, tier three, and tier four within the supply chains. A lot of them making parts out of metal. What we hope to do today is give you a sense of what we're seeing from Washington, and not just what we're seeing, but also give you some ideas for strategies and how you can adapt to it. My primary role, again, is a lobbyist. I work with the White House. I work with Commerce, USTR. I'm on Capitol Hill usually every other week, meeting with offices on a range of topics. It's not just trade and taxes or trade and tariffs. Last week I was dealing on taxes. We do regulatory work. But as Brandon said at the intro, the topic of the day, the month, and likely the next few years is tariffs. So to level set where we are right now, as of right now, we have a 25% tariff on Canada and on Mexico that's been suspended. We're going to start talking about that first in the context of the US, Canada, Mexico free agreement. We also now have seen a resumption of the Section 232 steel and aluminum tariffs of now 25%. That's coming on March 12th. The China tariffs, that's already in effect as of March 4th, and that's an additional 10%. And then there's the potential reciprocal tariff, which most people believe are targeted at the European Union, and that can begin as early as April 2nd. So we're going to get started with Canada and Mexico, move our way into where we are on steel and aluminum, discuss some China, and then talking about the next steps, all specifically in that order. Before we get to that, I do want to give folks an understanding of what are the other key important dates and why did we mention April 2nd on the reciprocal tariffs. On his first day in office, President Trump put in place 26 different executive orders and another 24 or so presidential actions. Among those was a directive to his different agencies and departments, from Commerce to USTR to Treasury, to come back to him by April 1st with reports on different trade topics, including expediting the review of the US-Canada-Mexico Free Trade Agreement, moving that up from July 2026 to now. Identifying whether currency manipulation is a factor, identifying where there's a trade imbalance with other countries, identifying which countries with which we have trade agreements that work, where should we engage in new free trade agreements. All of these are different actions that he wants reported back by April 1st. And we're going to get into the significance of that because the most immediate action that the president took on February 1st required zero investigations, required zero public input. There was no process. The president used the International Emergency Economic Powers Act of 1977. The IEPA, there are over 40 current emergencies the United States government has been in place. This is a presidential declaration, not subject to the courts, not subject to Congress. The president declared a national state of emergency on Canada, Mexico, and China on February 1st with his tariff announcement. I will note, in those proclamations that he put out in the executive orders, not one place did he talk about trade in goods. He was not talking about tariff imbalances and different non-tariff barriers put in place. They were focused on fentanyl, opioids, borders, immigration. This tells us this was an opening round. As you see here, the 25% tariff on all imports from Mexico are suspended until 12:01 a.m. on March 4th. The 10% on energy imports, we'll show you the definition in a few slides from Canada, also suspended till March 4th, as well as the overall 25% tariff on other Canadian products. However, the 10% of additional, and this will be important when we get to the China section, the 10% additional tariffs on Chinese imports are in effect now. That happened on February 4th at 12:01 a.m. There is no exclusion process there. So as we look through the next steps, we're going to flow through. We're starting with IEPA, the International Emergency Economic Powers Act that the president declared there. And that's where we are on some of these areas. Let's get started here on China because that's what's in effect right now. And feel free to type in any questions into the Q&A box over on your side there or even into the chat. And we'll go ahead and try to incorporate those as we get through these. But you'll notice the key point of this 10% tariff. They're not discussing imports of steel, imports of supply, imports of tier 2s and tier 3s. They're more focused on the rationale of why they did it for being opioids. This is an additional 10% rate on tariffs on imports coming in from China. What the president did in his first term, he imposed a 25% tariff rate on 6,800 imports coming in from China on what's known as list 1, 2, or 3. Those are largely industrial goods. 3,200 goods on list 4A were subject to a 7.5% tariff. The roughly 40% or so other goods that were not covered were set at a 0% tariff rate. Now, effective 12:01 a.m., as you see here on February 4th, all goods coming in from China shall respect with all goods entered in for consumption that are coming in. You'll notice in that first line, all articles. Here's what the practical impact of this now is. This is an additional 10% tariff. So on list 1 through 3 that had the baseline of 25% dating back to the first Trump administration, they're now at a 35% tariff rate. Those items that were on 4A, bicycles, some clothing, more consumer retail-oriented goods, those appeared on list 4A. That was a baseline of 7.5. So now they're at a 17.5% rate. So if you are on list 1 through 3, whether you're competing against it and you want to see a tariff in place, or you're importing from China, starting February 4th, it's a 35% tariff on an item on list 1, 2, or 3. List 4A, 17.5% combined tariff rate. And if you previously had a product not subject to an import tariff from China, it now has a baseline tariff of 10% rate. So for example, if you take a look at, these are stackable. When you're doing the section, this is a 301 tariff is the top line that you see right here. This top line, that's section 301 that dates back to Trump 1. That's the 301 tariff. You're adding it now onto the IEEPA tariff that he did February 4th. That's the second line. That's your total. If you're importing steel or aluminum from China, it is most likely covered by the Section 232 tariffs, which is an additional 25% rate starting March 12th. So if you're importing, and you should, at this point should not be importing steel or aluminum from China, or you better be looking for an out, because that's not going to change. That's a 60% combined tariff rate. That's in addition to the anti-dumping and countervailing duties. And there's over 200 articles of steel that are currently subject to an AD/CVD order from China. So these are how they are stackable. For those of you that are familiar with importation laws, and there is no duty drawback permitted under the Section 301 action, like there was the first time. So a duty drawback is if you are importing a product and then you're going to further manufacture it for an export, you don't typically have to, you can get reimbursed on paying the tariff upon the export. There's no duty drawback. So if this is an input that's being turned around and further manufactured, it's not permitted. Keep in mind, this is language for China, but also the same for Canada and Mexico were they to go into effect on March 4th. And within some members, you might have some goods that come in under what we call de minimis. That's a declared value of $800 per day coming in for that value. They are not permitting the de minimis, although for now they are until they get the program that's set up. So as you're considering your importation requirements, there are multiple levels. If you have one of your members that is exporting to China, the retaliation has already begun. Your members wouldn't be on this list, but you'll start seeing how they're increasingly adding to the 10% list and to the 25% list and 15% rather on the Chinese retaliation. That's already begun. And that's a theme you're going to continue seeing. I was on a call with Canadian and Mexican manufacturers this morning, and the Mexican individual said the conversation they're having with their government is when or whether the Mexicans decide to put out a retaliatory tariff list. And so the back and forth could certainly continue from there as you take a look at these. Again, feel free to type in any questions. We're leaving China and we'll head over into the what if. These are now the pending tariffs that have been suspended but are not currently in place that have caused the most disruption and consternation here in Washington, D.C. Certainly among my automotive suppliers, of which I work for 8 manufacturing associations with 4,000 companies. There's a lot of auto manufacturers that are very concerned and have been hearing from their OEMs. The 25% tariffs on Mexico that were announced apply to all articles. This gives you an example, and the Canada lines were very similar to this. They declared a national emergency with respect to the grave threat coming into the United States of the 2 items that he lists there. So this now has to lead us to believe, what will it take for him to not impose those tariffs on March 4th at 12:01 a.m. on Canada and Mexico? Is there an achievable ask or a request from the counterpart governments that can get him to this point when they are there? But it's important here to note that they are looking at this with regards to just coming in, all goods coming in from Mexico, and that's currently there in suspension. On Canada, similar, this is how the Mexico starts off, exactly the same way as the China one. It says all articles that are produced in Canada, as the definition puts out, again, subject to that 25% tariff. And keep in mind, if you are now automotive and you are moving that product back and forth, they can go 6 times, up to even 8 times. That's potentially a tariff every single time it crosses the border. So that means every time it would enter the United States, it'd be subject to a 25% tariff. It's still unclear on how far the president would go, whether or not if it moved multiple times, it would only be tariffed once, or more likely, it would be tariffed on the value add of the product. So if you shipped it from the US to Canada, there was some further manufacturing then back, then the value added of that would be the subject to tariff. or they could go back to square one with no agreement, and the product is fully tariffed at its full value each time it crossed the border, meaning the article enters the United States, it's subject to a tariff. The article goes into Canada for additional work, and that is subject to a retaliatory tariff by the Canadians. The Canadians have put out a tariff list of $30 billion already that they want to list as subject to tariffs on importation from the United States. So the product could go back and forth multiple times and be subject to that tariff multiple times. The US did create a separate list for energy resources that they define on the next page here, but that's only a 10% tariff rate on that. You'll take a look at the definitions for energy and energy resources in the transmission, generation, production, and some of the supply. For those in attendance from from Northeast, if you're in New York State, for example, and you are purchasing electricity from Canada, that would be subject to a 10% tariff were this to go effect on March 4th. I work for the die casting industry and the forging industry. That's a lot of energy those groups use. That's a very intense amount. If you're putting a 10% tariff rate on the utility that's coming in, that causes added disruption. As we look at our matrix of, does this impact me? Does it impact my customer? Does it impact my supplier? In this instance, you have to impact, does it impact my utility provider on the energy side as well? And so there's multiple factors to take a look at this in terms, again, these are suspended, as is the Canadian response that they said would have taken effect on February 4th at 12:01 a.m. This is the 25% on $30 billion worth of goods that are coming in. That is suspended again. Meanwhile, they did announce another list of $106 billion that they are reviewing under a 21-day period prior to imposing those tariffs there. This gives you an example of just some of the items, and you can see the full list that would have been in effect. So you should treat this as not pending, but suspended. It's the other items that are worth the $106 billion with the 21-day review that were intended to give the supply chain within Canada more time to adapt and try to seek some alternatives there as well. I know we received one question that we're about to answer it in the next section as we pivot over to steel and aluminum, and we're at about the 117 Eastern mark, and we'll try to wrap up here on the steel and aluminum around 24:25 and leave EU, Europe in retaliation for my final 5 minutes. So please do continue to type in any questions here as we go through on the next steps. I'm going to give a warning to folks that do a lot of steel work. And again, I got my start in lobbying for manufacturing, working on steel and steel issues over 20 years ago. I sat next to the chairman of the House Ways and Means Committee last week at a fundraiser, and the day before that sat across from the Energy and Commerce Committee chairman, and they were both in the White House previously, and they gave us a warning, said on tariffs, particularly on steel, this is personal for the president. The president said to them in that meeting, his four favorite things are God, country, family, and tariffs, not necessarily in that order. The steel tariffs he takes very, very seriously. What he has done now with regards to this is put in place the threat. Think of the inverse it. We're going backwards to where we were in 2018 when he came into office, or after he came in office and started putting in tariffs. On the Section 232 aluminum tariffs, what the president did in his first term was impose a 25% tariff on all steel imports from everybody. No exclusions, no exceptions. He then imposed a 10% tariff on all aluminum from the globe. When he moved on to provide what we call exceptions. The exceptions or the exemptions. Exemptions are for countries. The countries that were provide exemptions for either steel and or aluminum were Australia, complete exemption. That was on aluminum. Then he created an absolute quota system for South Korea, for Brazil, and Argentina. When a certain amount of metal came in under the quota system for that period, it was a hard stop. No more was permitted to enter in the United States. When Biden came into office in February of 2021, he struck a deal with the European Union because up until then, Trump did not provide them any relief. India, Japan, UK, EU, all were subject to tariff on steel and aluminum products coming in until February of 2021, when Biden then put in place the tariff rate quota system. The TRQs allowed for a certain amount of steel or aluminum to enter the United States, semi-annual for aluminum and quarterly for steel, and it covered Japan, the UK, and EU. When you hit that certain HTS code from the specific country, Then the tariff went into effect for the remainder of that quota period. Trump has eliminated that. There are no country exceptions. There is no exclusion process for an importer to petition the Commerce Department for relief. That is closed as of February 10th. All of those are gone. We mentioned that at the beginning, he's used the IEPA on Canada, Mexico, China. He's used Section 301 on China. This is the steel and aluminum national security tariffs of 232 action he did the first time, and they are back. There is no exclusion process. The generally accepted exclusions that they had granted under the previous administration are now gone. They are going to be, again, everybody reinstated at the 25% rate. So some countries did not have tariffs, Australia. Others had a quota of absolute, South Korea, Brazil, Argentina. The others three that had TRQs, EU, UK, Japan. Everybody else in the world, and if you're bringing in specialty stainless from Switzerland, you always had the tariff because they're not part of the EU. So that's how you want to focus on this. That means there's no recourse. I was told by a senator sitting on his couch last week, he said, right where you're sitting now, the nominee for Secretary of Commerce told me there will not be an exclusion process for steel and aluminum to petition the department to request a relief from not paying that. All country exemptions will be terminated on March 12th. If you have anything on the water right now, there is no retro look back. It is March 12th. So this is not like what he did on the China IEPA on February 1 for loaded on a vessel. This will be a tariff that comes into effect, and you'll notice this is how he eliminated for these allies on Mexico, on Canada. Those all go back. We get more than half our aluminum from Canada, for example, subject to a 25% tariff on March 12th, unless the president enters into some kind of agreement with them on that front as well. No duty drawback. That has not changed. That was always the case in the 232s. There was not a duty drawback. That has not changed. This now goes to the question that was asked. Does the China steel and aluminum tariff only apply to raw steel and aluminum, or does it also apply to parts, tools, etc., that are made of steel and aluminum in China? That's an excellent question and goes back to this baseline set. If you are part of the Section 301 tariffs, almost all of the products described, parts and tools, industrial machinery goods, are already listed on list 1, 2, or 3. So whether they're made out of steel or plastic or rubber, almost all of those already were subject to a 25% tariff, now making it a combined with the IEPA rate of a 35% tariff rate. Splitting that question in two is where we get to right now. The steel that's inside of, or aluminum that's inside of a tool, I work again for a tool industry, also folks that are making dies and molds, those folks, some of them are covered. What the administration did, and the language here is similar for aluminum, they are looking at expanding the 25% tariff list to not just cover the steel and aluminum, but also some derivative products. I'll give you examples from my clients. My metal stampers, 70% of their cost is steel. It's a stamped sheet of steel. Literally, they're putting holes in it or bending it into a cookie sheet. It is nothing but the steel. Yet because they've changed it, it has a new HTS code. It's not eligible for a tariff rate under 232, even though it really just came out of that coil of steel. That's where they're starting to go with this. So they've created an Annex 1. Here's some example of those where they're saying some products in here that can come in and be subject to that protection of a 25% tariff. However, this list is more expansive. I took some examples of the HTS codes that are covered by my clients. A quick example, harmonized tariff schedule codes and HTS code. Every good in the entire world has an HTS number to the 6th digit. So we'll get to 731812. Every product in the entire world has that. That's how we track imports and exports. Then they get down into more details at the 8 and the 10-digit level. So your industry has them. Mine are scattered all over between my associations. And so we pulled. So this is an example of some of them that are covered. My kids play a lot of baseball and a lot of soccer. Baseball mitts are covered under Annex 1 of an item that is eligible to be covered under the steel and aluminum. That actually fell under the aluminum. I guess there's a clasp or somewhere on there that must be it. Here's the however. That tariff rate of 25% only applies to the steel or aluminum that's in the derivative. So if my kid were to get the catcher's mitt imported from anywhere in the world, and it's got that aluminum and it's subject to that HTS code, then it's only the aluminum in there that's subject to it. Similar, if I've got a stamped product or a tooling or a mold that's been further manufactured or had value added done in Mexico, in Canada, or in China, that is only applied to the steel or aluminum that's on there. And then I'll take the inverse of this. If your product does not appear on Annex 1, then you are not protected by the 25% tariff. Or if you're an importer of it, you are not paying that 25% tariff due to the steel and aluminum 232 action. If you are bringing it in from China, you need to cross-reference where it falls on IEEPA and 301. If you are bringing in a tooling, a die, or other supplied good not from China, then you're going to focus on the 232 steel and aluminum, see where that falls, see then does it hit Annex A, and one more complicating factor. The Secretary of Commerce has been directed within 90 days to come up with a process to expand that Annex 1 list beyond the products that were already included. Expansion of that is going to be an application process. You better believe my stampers and my emails blowing up from my clients saying, how about us? Let us apply, because all you're doing is shifting injury from the steel industry down to that tier, or up to that tier 2 or tier 1 supplier who's that steel user. There's 167,000 steel worker jobs in this country. There's 6.2 million industrial steel using jobs in manufacturing in this country. And so as we look at that injury, the administration has started to recognize that to an extent, but it's an application process. And not every product coming in is going to be covered. So as you go through the next several months, it's important to, one, watch March 4th for Canada, Mexico, watch March 12th for all steel, aluminum, and derivatives, and now start watching those April 1st reports that I mentioned. In the last 3 minutes here, I did want to flag for you the overwhelmingly complicated situation here that I think that Mark can also touch on. This is going to be a mess in terms of reciprocal tariffs. Don't just view this as a tariff action. And yes, it's predominantly targeting the European Union, but the UK is on this list, India is on this list, Brazil is, South Korea is. The president has directed his agencies to identify barriers to trade directed against United States businesses. What this could mean, if you're a medical device manufacturer, I've dealt with this issue in Asia. You can have Japan, I believe it is, puts different standards on US medical devices. That's a non-tariff barrier. You have different automotive safety standards. This was a problem with South Korea over the years on automotive parts. That's a non-tariff barrier and discriminates against US imports. The president is looking to find a way to monetize that and put a tariff rate on that. The big one is also, if you look at duties, we already apply what we call Schedule 1 general duty rates. On automotive, it's 2.5%. On other tooling and other parts, it might be 3.7, 3.8% on Schedule 1 for many of our trade allies with whom we don't have a free trade agreement. But the other side of it, if you look at Portugal, they're hitting 27%. You're looking at some other areas that are in 15, 20% duty rate. That's by product, which means the administration is going to be tasked with going by each product across the world and saying, what are they doing to us? We now need to do to them. And it's stackable. The last one, the big one, is also the value-added tax. The president has singled out also in the proclamation, the executive order on the investigation for reciprocal tariffs, the value-added tax specifically, and looking at that as a barrier to trade. The average VAT in the European Union is 22%. Does he take it literally and apply a 22% value-added tax in turn on all imports coming in from the EU, on top of a 232 25% tariff on steel, on top of any other actions that he's taken? When I say that April 1st is just the start, what we saw right now is just the start, I mean it. We were told last week in that fundraiser with the top guy on the trade committee that once he gets these reports back, and I started this by saying IEEPA, no legal restrictions. He did not have public comment period, did not have to go through investigations. If he wants to expand the 301 tariffs, he might have to launch an investigation to a new country. If he wants to reinstate the 232s, looks like he's got cause to do it. If he wants to do 122, which is imbalance of trade, deficits there, he can impose a 15% tariff for 150 days, no checks and balance. There is a lot of things that he can do, especially as he seeks to expedite negotiations with Canada and Mexico that are up there. So just keep in mind that we're only 29 days into this administration. And as a lobbyist for now my fifth administration, I got here in 98, the back end of Clinton, it almost feels like Trump never left. We only have 14 more days until Canada and Mexico. This is a deadline that I think might be extended, but he's not going to lift the tariffs. This is round one, especially as we get into the USMCA talks. And I was told by somebody very close to this White House that do not underestimate the president's willingness to walk away from NAFTA. He will do it if he doesn't get what he wants out of Canada and Mexico, and those are absolutely real. So we've got just over 3 weeks now till the March 12th steel and aluminum global tariffs take into effect. The reason we do April 2nd, because he's going to get the reports on April 1st, the next day, and 43 days from today, and 1,431 more days. Don't think we're done with tariffs, folks. This is going to be here for a while. And with that, I'm happy to turn it over to Mark and take you around on this roller coaster a little further.
Thank you. Wow. That was a lot of information, and good job this is recorded, because I'm going to need to go back through that, and I'm sure there's going to be some great questions on the back of that. So now what we're moving into is Omar's said what's going to happen, why it's going to happen. What I'm going to talk about is what's it going to do to us. And whether you are an American business, Canadian business, Mexican business, British business, it's going to have an impact. We've seen, for example, in the UK, a bit of this already. We went through Brexit. We just at the same time COVID was really in full flight, where we saw the impact of pricing on what I would deem as or inflationary pressures. Albeit tariffs have the ability, I think, to go both ways. And I think that's the challenge. Prices could go sharply up and sharply down as the tariff is added or removed. And that's where the challenge really presents itself. Because when we think of the tariffs and we think of the value, as businesses, and I'm really thinking here about businesses, for example, for distributors. Well, for a distributor, if we look at a scenario here, a distributor pre-tariff has 60 units, which hopefully we can see up here, 60 units of running total balance at 6,000 in value. And that's a pre-tariff, that's what they've been buying. If no tariff was ever to take effect, as they sell through those 60 units, selling them at their normal price, they would make 1,200 profit on the basis of how they're trading. If, however, a tariff is implemented, a 25% tariff, what will happen overnight, if they're not careful, they will immediately change the pricing to their customers, and they'll stick on 25% to every product. So rather than charging $120, they're going to charge $150 as an example. And we're really trying to keep the math simple here. Selling through those 60 items, well, they were bought pre-tariff. So they were bought for a much lower cost. They'll make 3,000 on selling through those products. So they will get a really, a short-term profit boost, which you might think, well, that's great. The problem is what goes up can also come down. And this is the scary element. Let's, for argument's sake, now say they've got 60 units of inventory bought at the tariff price, and then the tariff is removed. If they'd have traded normally through the tariff rates and nothing had changed, they'd have made 1,500. But now, customers will not accept it both ways. They won't accept, well, you stuck the tariff on me on day one when they came in, but you want to hold it in my pricing for longer until you've sold through the inventory. So I think working with your customers and understanding these things are really important, because if you simply change your pricing at the tariff point, What you would do here is you would make a loss, because what you've got is you're now selling the products without the tariff rates. So you're back down to selling them for 120, but the products were costing you 125. And so this is the real danger. And you've got to understand whether how does your accounting system work, or your ERP? LIFO, FIFO, moving average cost, or replacement cost. In many cases, it's FIFO or moving average. And they're the two main systems. You would get this effect with those two main systems. Whilst I can't guarantee it, you would need to check with your accountants. There's a very good chance that those temporary gains that you accumulated, you can't hold them. You can't hold them back knowing losses are going to come if the tariff is then removed. You can imagine it from the lens of the IRS. They're not going to be happy that you've made a lot of profit that you've decided not to declare and therefore not to pay tax on, because you know a loss is coming. They would like you to pay the tax straight away and then report the losses later on. The challenge with that is again, legislation has changed in the US on carrybacks on tax claims. And so you can't back claim and offset current losses against prior profits anymore. What you can offset them against future profits, but be mindful of these things. These are you do not want a bumpy ride in terms of pricing, unless you can keep it in sync with your true inventory costs. So be mindful of this one. The other thing to be mindful of with this is, how do you apply the price? You can do what we've typically done in the past. So we've got the before scenario. We're selling it for 100. It's costing us 80. We're making 20%. The tariff comes in, 25% tariff. So we increase the price by 25% because our cost has increased by 25%. Good news is we're making more profit now, and we've kept our margin the same. Your customer, if they're smart, might not like that, because actually they're going to say, well, hang on, you're actually making dollar terms more money out of me because of these tariffs. And so hence why surcharges are sometimes more appropriate, because they're more transparent. You're only passing on the dollar increase as opposed to the percentage increase. So when you do a surcharge mechanism, what you're going to do is you're going to still charge 100, because that's your commercial price, as opposed to what I class as a tariff price. You then create the surcharge of 100, which replicates the extra price of the cost of goods, and used to make the same amount of profit. The downside is, look at that margin number. Your margin as a percentage has just dropped 3%. So if that is the route you're going to adopt, you have to be mindful about how you monitor performance of your business, because surcharges may drop your percentage margins. And if you're not prepared for that, you might start to panic that you're not actually landing the tariffs, for example, in the marketplace. But the reality is, it's purely because of the kind of the mathematical mechanics. A way around this is to, when you actually look at the numbers, and here's those numbers again. So before and after using a surcharge, we went from 20% down to 17% margin. If you prepare or you have the flexibility in your system, or you actually take the numbers out of your system to report them, what you might want to consider is educating your stakeholders. In essence, what you do is you move your surcharge down as a reduction of your cost of sales. You can't do this for proper accounting purposes. This is not something you can put in your tax return or your financial statements, but it is something you might want to do in kind of what our class is internal reporting. When you do that, you get those numbers. You're back to where you started. You're now, so you're now back to your 20%. The other key thing here, and there's quite a few of them. First thing, how do you compensate your sales team? Because if you compensate them on sales revenue, and you're about to stick 25% on your sales revenue, I'm sorry for the salespeople out there. You got to think about that. Customer credit limits. Do your customers, will 25% suddenly max out their credit limits? And I keep using 25. Be mindful, as Omar stated, these are stackable. So it might not be 25. In some cases, it'd be less. In some cases, it could be more. You need to understand what is it going to do, not only to your customers' credit limits, but to your own credit limits with your suppliers as well. And so you should be mindful of these things. Other areas that I can see being a challenge, the valuation of your inventory. In many cases, as a business, we have an insurance policy to cover our inventory in the event of fire, theft, that kind of thing. If suddenly your inventory overnight, you're suddenly buying it in at a much more a higher rate, do you have adequate insurance to cover that value of your inventory? You don't want to find yourself underinsured. Rebates. Rebates were always going to be mentioned. With rebates, be very mindful. Again, if suddenly the cost of business between two parties changes and all rebates are structured on value, what you don't want to be doing is paying out rebates to your customers purely because you've applied tariffs. So if you're doing surcharges, can be great for this because you could exclude surcharges from rebate mechanisms, but you need to make sure you've got the systems for doing so. If your ERP can deal with surcharges, great. If it can't, I would caution people to be very careful because you can get yourself into a mess very quickly, starting to try and play with all the costs. Other things to be mindful of with tariffs, and I think just trading generally, be very cautious about cross-border rebates. You do not want to start trying to change the value of goods crossing borders retrospectively because a rebate tier has now been achieved or something like that. So be very mindful of that. And then the other side of it, more for the financial accountants, if the values of everything we do in business are changing, it could easily change reporting thresholds for things like, do we have to start paying tax quarterly versus annually? Do we need to make extra submissions? Those kind of things. There's lots of rules. I can't go through all of them because they vary state by state as well. But you need to make sure that your accounting teams are prepared for this. Are you having conversations with credit insurance ahead of time? And then finally, liquidity. You need to, I would recommend stress testing your cash flow now before these things take effect. Understand what will break your cash flow. It's not to say it's going to happen, but you need to know when things are announced what that impact will be rather than waiting for the impact. So there is a good chance there will be a scramble for cash if everything costs more. You might see tier one manufacturers holding on to cash, changing payment terms, really forcing this. You could see it. So you could see this on both your customer and your supplier side, depending on where you are in the supply chain. You could get squeezed purely on payment terms. But then you've got the other side of it, which is if you're out of sync, you're suddenly going to be paying a lot more for the product yet, and you haven't been paid for it by your customer as well, if those terms go in the wrong direction. Now would be the time to start having conversations with whether it's your banks, your lenders, whoever, to understand and be prepared ahead of the game for these things. And as I say, you want to stress test. It is a lot of Excel work. There's not many systems out there that are going to do this straight out of the box, especially not in the time we've got. But as an example, I spent just this morning just building a couple of models to work out what would be the impact of tariffs. What's the effective rate of a tariff on a product if it goes in and out of a certain countries, some values added, and then this happens. You can build these models. Hopefully you have, this is where accountants should shine. My fellow accountants, we can get out our spreadsheets and we can show these impacts, and you build it from the ground up. So that, with that said, here's the one I built this morning. It might be wrong. I've had to put for illustration only, but this was something I built very quickly, which basically said, well, at stage one, we've got a load of product coming into the US, some from China. I understand now it will not be synthetic diamonds because they've banned the export of synthetic diamonds to the USA, apparently. But what you're doing is you're saying, well, we've got these tariffs on these products coming in. The US is then going to do some processing. It's going to add some value. That product's then going to go to Mexico. So Mexico might apply their retaliatory tariff. It's then going to have some more value added in Mexico before it comes back to the US. So we're going to stick their tariff back on it again. There's non-compounded and compounded there. It shows you the stark difference between the two and the effective dollar increase and percentage increase. This I whipped up in less than an hour. If any finance team worth their value will be able to put things like this together that can be automated, dynamic. This looks at a different spreadsheet where I maintain all my tariff terms and automatically calculates these things. So with that in mind, I will hand it back, Brendan, for the Q&A session. And all I would say is, yeah, it's time to get those spreadsheets put to work.
There we go. All right. So I love that there is a moment, and I'm sure there's lots of moments, Mark, where the accountants get to shine. But you guys get your day in the sun today. So I think that we had one additional question came in that I think is probably for you, Omar. It was similar to David's original question about EU and steel, but it replied to the EU. Can you answer that one for us from Raphael?
Yeah, of course. The question came in, does the EU steel and aluminum tariff only apply to raw steel, aluminum, or does it also apply to the finished goods that are made of steel and aluminum in the EU? And this is where it is different from the China because the EU doesn't have the 301 tariffs. As of right now, it would only apply to that raw material, the steel and aluminum, that appears in case of steel, Chapter 72 and some of 73, and in aluminum, Chapter 76. Then there is the derivatives. That's where Annex 1 is. So the first part of the answer to your question is, it does only apply to the EU steel and aluminum. If the product also does appear on Annex 1, then the tariff does apply to it in whole if it appears on Chapter 73, which is an article of iron or steel, or if it appears in Chapter 76, an article of aluminum. Then it would also apply to the entire value of that product under 72, 73, 76. If you are not on one of those chapters, where many of my clients are not, if you're on Chapter 84, so you're parts of machinery, for example, I'm flying to go speak to the AMT and the NTMA conference tomorrow. I speak 30 conferences a year, and I'm going to get a lot of questions tomorrow about this exact question. Does it going to affect them? Well, it'll apply only to the steel in that product if it's not in one of those primary steel or aluminum chapters. So if you're in the machinery chapter, which is 84, and it's coming in from Europe, the tariff would only apply to the steel and aluminum in that if the derivative list were expanded. So, or if it was on that Annex 1 list. So your default, it does apply to all steel and aluminum coming in from Europe and on steel and aluminum. It could apply to the steel and aluminum in a derivative product if it's listed on Annex 1. And then it gets more complicated as they separate it out even more under the derivatives over time. So this goes back to my example of where my stamp product or my mold or my others, where the vast majority of their input is steel, but they're competing with it. No, their competitor is going to ship their finished stamping in tariff-free unless they get their product added to the derivatives list. So if you're a consumer and you're an importer, you want to take that argument and make the inverse of it. So if my good that I'm importing is not on Annex 1, is not on the expanded list, then there is no tariff on that product. If it is a steel article under 72 or most likely 73 or aluminum under 76, yes, I should assume by default it will have it. The other complicating factor, I had a client ask me last week, I have a choice, buy from Italy or from Japan, what should I do? Gave him disclaimers. And I said, the challenge with Italy is it's part of the European Union, meaning it's not just up to the Italians to cut a deal with Trump. they've got to get von der Leyen to cut a deal with Trump, meaning all of the EU, in order to protect Italy. Whereas the Japanese, it's a one-on-one negotiation, and so there's less baggage for Japan to get a carve out. Every country that ships or makes steel and aluminum is looking for a carve out right now. That is what they are trying to do. So for you all that are bringing metals in or even tooling that's coming in from overseas, you have a two-parter to watch. You have to look at those annex and the derivatives, then you've got to look at the country itself, having not even gotten into the melted and poured requirements that they've added on there.
So follow-up question for you, and then I've got another question for you, Mark. Where do people, I mean, I know that we have contact information for you, but for those that like to do research, where do you get a lot of this information? Where do you get the complete list? What comes out of the White House is maybe harder to follow. What do you suggest to those people who love to dig into their own content and the research? What should they do?
Problem is not in a set place, to exactly your point. You have to go to the White House to get the executive order. Then you have to go to the agency to get the Department of Commerce Federal Register notice. So we got the order on steel on February 10th, but I didn't get the derivatives list until 11:30 in the morning on Friday, February 14th. And that is still not cross-posted to the White House's website. So honestly, you have to go to your associations, go to those resources that you can trust to where they've got them together. You can go to publications like Inside Trade, for example, and a few others. But too many national publications are focused on the noise of tariffs and not the implication and application of tariffs, which I think is where Mark is going with. And for those, it's scattered. For government resources, you have to go to the Commerce Department, USTR, and the White House right now, or just find that trusted group that you've got to go through.
Yeah, I mean, I think that it does. The whole reason why we're doing this is what came out of the news was just panic, and a lack of understanding, but a desire to act quickly. And we've seen some early actors in price increases and whatnot. And so this kind of leads to my other question for you, Mark, is, we've seen some people put in place price increases, and then, we've also seen, the structure around the surcharge. We also heard from our end user panel last week how important transparency was, and that they would be willing to accept increases based on this. How are you seeing this work well, and then how are you seeing it not work well? Maybe give a couple examples or just one example of each, just as a cautionary tale for our audience.
Yeah, I mean, the transparency is really important. I think everybody's memories are still fresh from what we saw when we saw kind of as we put it, was it price gouging? And I think people are prepared and know that if price increases, if there's a genuine reason, they accept them. And they appreciate that it's beyond your control. It really falls apart when you don't see that transparency. So in that scenario I showed, where a surcharge is great because it's transparent. My cost has gone up by $20. I'm going to increase the price to you by $20. Where the customer gets upset is, my cost has gone up by $20. I'm going to maintain my margin and I'm going to pass on $25 to you. And if you imagine if that happens at multiple stages in a supply chain, the effect just grows. And so I think everybody just has to have a level head. The other thing as well is, you've got to understand, is this permanent or not? Because surcharges are intended to be, I would say, more of a temporary measure, but not that they can't be used long term. So for me, it's the transparency. It is that's where it goes wrong. And as I mentioned, that idea of sticking your prices up on day one when the tariff takes effect, but then holding them up until you've sold your inventory through when the tariff ends, things like that, to protect your own margins again, are not going to be well received in many areas. It is tricky as well, though. What I would say is, transparency sounds easy, but like I said, a lot of this is going to end up going back to the spreadsheets. And unfortunately, one of the downsides of spreadsheets is they don't foster, they're not a collaborative piece of software generally. I mean, I still have nightmares in the days of sharing a spreadsheet, and then yeah, it's got better, but it's still not good. But I think if there's ever a time to be closer to your trading partners, now is it, because you're all in this together. This is not some, and it's something as well that you're in it, and you're on the kind of, I won't call it the roller coaster, but you're on this ride together no matter what. So helping each other to get through it is going to be the best way to navigate this, and really trying to educate the end consumer. That's the most important thing. You can do whatever you want in the middle of the supply chain, but if the end bill payer, the end consumer, does not accept it, then everything in the middle, it was just moving dollars around. So supply chains have to think about how they're going to keep the end consumer educated on these things as well.
That communication is important. I'm looking at a letter which won't say the company names, as I have a feeling it might be one of your members, but it went to suppliers that said about tariffs that their division will not accept price increases related to tariffs, taxes, or duties. We do not consider these pass-through costs, and they should not be rolled into effect. And so having those conversations, to Mark's point, even before you get this letter, is going to be important to do.
Yeah. Transparency is key. And that came out loud and clear directly from our end users. So a couple of housekeeping items just for everyone listening in, and then I'm gonna let you guys have your final word. First, so much information was in this webinar. It was recorded, and it will be available to anybody who listened in, as well as people who weren't able to make it today. We'll give you links for that, and so you can get back in there. I'd also ask maybe there's contact information for both of these wealths of knowledge. Please do reach out to Mark and Omar if you have specific questions. I'm sure they'd be happy to talk to you and work through whatever scenario you might be playing with. The last thing is this conversation obviously isn't over, and we're going to continue this conversation in earnest at ISA 25. So Mark, I know I'll see you there, but we have a government affairs update from NAW. We have an end user panel where we're going to be getting updates from the end users on how they're actually absorbing these post some of these deadlines that are looming. So you'll want to be there to keep this conversation going. And we're going to continue to report on it here as well through other webinars, thought pieces, and other smart people like Mark and Omar that have opinions to share. So guys, I'm going to let you have your last word. Omar, what do you want everyone to walk away hearing as your last final send-off?
No, this is just round one. This is going to be a long process. We're in round one of tariffs related to Canada, Mexico. This is a firing shot. This is going to be a long process, and tariffs are here to stay. Politically, right wing, left wing, I'm hearing that from both sides. So finding those trusted sources that you know, we work with Chris Blaylock over at Whiffley and his team, and they're helping folks also similar to what others are doing around here in DC and elsewhere. So finding those resources that you can trust. Please don't just stare at the headlines. Don't make business decisions based on what you're seeing in just the national press. Reach out to those associations that you know and can trust. The conference is going to be a great place for you when you're in Opryland to get that kind of intel too.
There you go. Mark, last word?
Yeah, to mirror Omar's point, I'd firstly like to thank Chris Blaylock at Whipfley for introducing me to Omar and allowing us to have access to that expertise. So thank you so much, Chris. For me, it's really about understanding things now. Don't wait. This is, you mentioned, Omar, the letter that came out. Well, that's great because a line has been drawn. So at least people can prepare for it now. If you're not sure what a supplier or a customer is going to do, ask them now, agree it now. Don't wait and just hope for the best, because I think that is a dangerous place to be.
And start listening to those accountants, right?
That's it. Listen to the accountants.
All right. Well, this has been super informative. Again, the recording comes out for everyone who's listening in. You can go back, you can rewatch it, you can watch it at a faster speed. My guess is I'll need to slow the speed down a little bit. Not everybody has that ability to comprehend so much information in such a short amount of time, and it is a lot of information. So please do reference back to it, share it with others. We want to spread the word. We want our industry to thrive during this period of chaos, and so that takes everyone being really well prepared. But that's all for today. Thank you for attending this ISA webinar. Again, available to all ISA members, all of their employees, as well as, you know, many guests who are joining us today. Sign up for ISA 25 if you haven't. That is in Nashville at the Gaylord Opryland, and that is on March 31st to April 2nd. It is an action-packed agenda full of lots of good thought leadership like what we just heard here, but also this is your opportunity to, as these guys recommended, stay close to your supply chain partners. Manufacturers, be with your distributors. Distributors, be with your manufacturers. And this is a great opportunity to do that. So signing off from ISA webinars. Appreciate you guys being here, and have a great day. Thank you so much.
Thank you.